Welcome back, or welcome if you're just joining us. This is Ensuring Success. I'm Gail Perry, Editor-in-Chief of CPA Practice Advisor, and I'm here with my co-moderator, Alexander D. Felice, and we are going to present a session to you right now on new tax legislation and what you need to know about long-term and short-term planning for the new things that are changing in the law. We have a panel of experts for you this session, who include Andrew Argue, Jim Duggan, and Sarah Adkisson, and I'm going to have each of them introduce themselves briefly, but first I just want to thank our sponsor Corvi, who sponsors this session. I'd also like to do a quick shout out to all of our sponsors who are making this event possible, and that includes ADP, Ace Cloud Hosting, CPA Charge, Avalara, BotKeeper, ComplyRight, Corpay, Corvi, CPA.com, eFile for Biz, Intuit, QX Global Group, Right Networks, SafeSend Returns, Sage, SureLink, TaxFile, Vic AI, Walters Kluwer, and Xero. We thank them all so much because we would not be here if it weren't for our sponsors. So also, I want to mention just briefly, if you are just joining us, how CPE works for this session. If you're planning on collecting CPE credits for this session, we will display 3 separate 3-digit codes during the session. They'll display at the bottom of the screen. I'll call attention to them. You'll need to write down these codes. So altogether, it's 9 digits, 3 separate codes of 3 digits each. That you'll use at the end of the day or at the end of tomorrow or whenever you're ready to get your CPE credit. You'll just click the Get CPE option at the top of your screen, enter the codes for each of the sessions you attended, and you'll be able to download your certificates. I'd like to also mention that we will be sending to you a digital tote bag in your email next week, which includes special information and offers from all of our sponsors who are participating in this event. So keep an eye out for that. And now I'd like to turn this over to our panel members. Let's start with you, Andrew. I'd like each of them to introduce themselves.
Gail, thank you for having us on again this year and accommodating us in this quasi-remote environment. Just a little bit about myself, to introduce myself. My name is Andrew Argue. I'm the CEO of Corvi. I am a certified public accountant, came up through the normal rungs, worked at one of the large accounting firms. And, years ago, my wife and I, even though we were CPAs, we didn't prepare our own tax return. And so we went and got it prepared by someone else. And we did that for a couple of years until one year we realized just how much we were overpaying in taxes from working with this individual who was also a CPA. So was my wife, 3 CPAs, right? It's like, how many CPAs do we need to properly deal with this tax issue? And that was really the beginning of what has now become Corvi. And so Corvi is a tax planning software company, and we'll have the opportunity to talk a little bit more about it later on today. And we've helped a little over 2,000 accountants around the country help another 40,000 businesses and individuals move from just filing their return to actually doing proactive tax planning.
All right, and Sarah.
Hello, my name is Sarah Adkisson. I'm a senior tax law analyst at Corvi, so I work under Andrew. I am an attorney. I'm licensed in both Maryland and the District of Columbia. I have an LLM from Georgetown in taxation. I kind of discovered my love of tax a little late in law, so excuse me, I'm getting over a cold, so I might be coughing a little occasionally. But I just discovered a passion for tax law and have been searching for ways to help people understand the tax law ever since.
All right, and Jim.
Thanks, and thanks again for having me, Corvi. Always a pleasure. Name is Jim Duggan. I have a firm in Chicago called Duggan Birch. I've been practicing with business and corporate trust and estates and tax on an integrated basis for private clients for about 28 years now. And crazy, I also have a passion for tax, and I did not want to be doing this at all for my life, but I fell into it because that's what the clients needed. And it turns out I like this stuff. So it's always a pleasure to be here with a bunch of tax-minded people, and hopefully we can help our clients together. So glad to be here. Thanks again.
Excellent. Thanks for those introductions. And especially we want to thank Corvi, who is sponsoring this session. And we want to start our session with a little bit of general information about what actually are the major pieces of legislation that are impacting our taxes that we want to be aware of this year. Andrew, I'm going to turn it back to you to start.
Absolutely, yeah. So obviously, the last really 2 years have been quite a storm of, rapid legislation and looking at all the changes that have come out. Really this year, when we look at it, the three major items that have either been passed or are on the docket is really the ARP, right? The American Rescue Plan, which many of us are already familiar with. And then we just had the recent infrastructure bill that has been passed and is now signed into law. And then we still have that Build Back Better and all the different versions that started out with the American Families Plan and the American Jobs Plan, which now is sitting here with a couple of key dates between now and the end of the year, going back and forth, has passed the House. But from my perspective and from our research, if it does end up passing, we'll likely go through some changes in the Senate if it does end up passing through. And so, right now, when you look at it, being December 8th, with only a few days left in the year, all of us have to help our clients make decisions in light of what has passed, some of the recommendations that we maybe gave them, right, that maybe now need to be reversed when you look at things like ERTC and other issues that have come up, which we'll talk a little bit about today. And then also looking at, what might come next year. This last bill, the BBB, really is not what was originally proposed, but there are still some items that will go through and need consideration once we get the final law passed here in the next few days, if it does go before the end of the year.
Okay, and also we're interested in who the key players are who we want to keep an eye on in Congress, who are going to be very significant in determination of which of these bills are going to be passed or how things are going to be changing.
Jim, you want to take that one?
I think the most important part is who was the most important and why we're dealing with things in this act that we may have to reverse our course. So, I focus really more on the House than the Senate at this point. Is that we had Kyrsten Sinema to thank for the lack of any adjustments on the corporate tax side or the high income tax, where you would have had increases in both capital gains rates, ordinary rates, and the corporate tax rates. When they scored the current act that's in the Senate, and they discovered that we weren't going to have any significant changes because it actually scored out pretty well. One of the key points there was that it was going to be the enforcement that they were relying on to create more revenue. So just to point to all the accountants on the phone who do controversy work, get ready if this goes through, because the audits are likely to double. And that's how they're expecting to get $200 to $400 billion of increased revenue to offset some of the provisions in the act. So you're looking at what I think will be a lack of drama like we had in the House. I think there's going to be some maneuvering between the two to reconcile when it goes back. But I would imagine that in this current form, you're not going to see too dramatic a shift from what's there, just given how it's scored and what we've already been through. I do want to address what Andrew mentioned before is when I presented previously on this, on all the prior acts that had been proposed. And at the time, we were still dealing with the 99.5% Act, if you remember, on the estate side. The timing that we were expecting this to be passed, and when it would be effective, and by all accounts, the most likely scenario was always going to be January 1st of next year. And it looks like we're still on pace for that. But I also included in my chart of probabilities there that it could be thereafter, right? And there's actually already been suggestions that this won't be done this year, that we have too much on our plate right now, and this could be a 2022 issue. Now you get back in that whole conversation again, is what if it isn't agreed upon until March or April or June of next year? Is that going to relate back to January 1, or will it be on the date of enactment? So we had included that as a somewhat likely scenario that it could be pushed because of dysfunction, and I still think that's possible based on everything going on right now. So I'm not expecting this to be in this current form as of 1/1 with 99% certainty. I think it's still likely, but it could also get pushed off even further. And I'm not really seeing any one person sticking out as the main obstruction point.
Yeah, and I'll add a couple of points to that as well. I think a lot of it has to do with when you look at these senators that have stood up. You mentioned Sinema, and then you also have Manchin. When you look at it, that was the original two that had various sticking points with the most recent bill coming out, the Build Back Better. And one of the interesting things to watch is you kind of see people in their own party step up and say, hey, maybe we shouldn't be passing some of these items. But one of the interesting notes is that doesn't necessarily reflect in them losing popularity in their home state. And so if they're not going to lose popularity in their home state, you look at Joe Manchin, even though he's pushed up, he's been doing quite well in his home state. So you're likely to see some of that resistance still, which means it might not get passed. It may not get passed till next year, or some of the key items that they don't want have come out. One of the key things that has been interesting to watch is probably the biggest fear points for most people did end up coming out. So when you looked at, I think the biggest fear point that we had coming into this endpoint that both those two senators were worried about was the increase in the capital gains rate. And in fact, so many people actually took action this year, doing transactions, making things happen before the end of the year. And now it really, I think the likelihood of a capital gains tax increase or a retroactive is basically nothing at this point.
I'd like to pause just for a moment to put our first CPE code on the bottom of your screen. So we'd like you to record this number, first of 3 codes that you'll get for this session. And I mentioned earlier that you would click on the Get CPE Credit option on the top of your screen to get your CPE when you're finished with this conference. It's actually on the top of the insuringsuccess.com screen that you'll go back to that. So it's not above the video display that you're looking at now, but on the Insuring Success home screen, you can go there and there is an option on the menu to get your CPE credit. So that's the logistics of how that's going to happen. All right, so let's get...
I actually kind of wanted to jump off something Andrew said there. I was really surprised that they took out the estate tax exemption, to be honest. Like, that seemed like a very low-hanging fruit. But like Andrew said, it was not very popular for a lot of people, but it's very interesting because a lot of people, everybody thought that was going to be the easiest thing to change. Like, everybody thought that was going to be changed. And so I know a lot of practitioners were talking to their clients about, take advantage of this while you can and before the end of the year. And now there are these people who may have planned for this at the end of the year who have to go back to the drawing board.
Yeah, it's almost a great strategy for the government to do this on a regular basis. Just suggest they're going to increase the capital gains rate, make everybody sell their business and then not do it. And then they're going to, get realized events. I was surprised by that too. I really think where we're at now, I think so much drama happened in the House. That's why I'm not expecting a whole lot of dramatic swings in the Senate, but you never know. Anything can happen as things adjust. I really do. I find it remarkable for all the things that fell off the final legislation, both on the income tax side, the corporate income tax side, as well as the estate side. I think we were running scared mid-year, not just to sell businesses because of capital gains there, but also everybody came out of the woodwork to start doing wealth transfer if they had estates worth over $10 million, right? Because now we're going to go back down to a $5 million number. Before it was set to sunset. And, now I am dealing with a different, people who started selling their business, they're still selling their business. But on the gifting front, for the people in that $10 million to $20, $25 million range, we've had to adjust to say, hey, this is now a little bit of a head scratcher. Maybe you don't make a gift because, the law isn't going to change just yet. And we do a little bit of a wait and see. So there were some dramatic things left off at the last minute. And, Sarah, to your point, I feel like some of that was really easy to keep included and was already accepted by the masses that it was going to happen. And yet, because of one or two, congressmen and congresswomen, didn't happen. So very interesting.
So can we flip that over and look at the other side of what is on the table and what does it look like is going to happen if we can get some legislation passed?
Sarah, let's start with you.
Oh, okay. Well, I mean, obviously, I think probably the biggest thing that people are looking at is that surtax on the ultra wealthy. I think that's going to be a very interesting thing if it passes, because it definitely seems like it's going to end up being a big fight as well. There's some constitutional issues there. It's going to be really interesting to see what happens if or when that remains in.
Yeah, I think the big issue there was, again, I thought a 39.6 rate would have been widely accepted again, and it didn't have to go there. They kept it at 37, but introduced the surtax at 10 million at 5%, and yet another surtax at 25 million at 3%. The constitutionality is very interesting as well because it's narrowing in on a handful of taxpayers, right? So I agree with that, and there may be some objections. The thing that really concerns me is tying that income into the estate and trust world is that those surtaxes will hit. You have this huge number of 10 million and 25 million when it comes to individuals, but when you're dealing with estates and trusts, you're going to get there at 200,000 and 500,000 respectively. So that's a remarkable shift, to imagine having income in a non-grantor trust of 200,000 and not just dealing with our basic issue of a compressed rate, right? We're at the highest rate very quickly. If you now take a surcharge of 5% on that income, and if you have a $500,000, another 3%, that is a very dramatic shift on the trust taxation world. So, I think that surtax is a big deal, and it's going to call into question a lot of, grantor trust. Do we try to switch into non-grantor trust if we can? Switching to grantor trust if we can. You may not be able to in certain circumstances, so you may be stuck with it. So I think that's a very dramatic shift from the tax standpoint on the trust side.
Yeah, and I think a couple of the items that are going to affect, really almost everybody in terms of your firm are going to be the potential change in the NIT, moving that to flow through income, the net investment income tax. That's going to be very interesting to see if that ends up going through and passing. Then also the SALT deduction cap changes. Obviously, that's a super popular one in the media, right? Everybody talks about that, and that'll occur in so many for so many clients. And then I think we already kind of mentioned it a little bit earlier, but the potential change, which this seems to have bipartisan support, which is the IRS increased budget for enforcement, right? Which I think when that goes through, it'll be interesting to see where that ends up rolling out and what effect that has. The IRS really is already increasing their staffing, or trying to, right, to grow to anticipate actually receiving that funding. So it looks like that will go through at some point, given that bipartisan support. And so I think those three items are three things that will just affect so many clients in most people's book of business here on the call today.
Yeah, I will say this, Biden's promise was it was going to affect people making over 400,000 for the most part. That's pretty much been a clear threshold on all these provisions. I think that NIT expansion is horrible. So for those who don't know the background of it, it's, you're paying for Obamacare, right? And all the challenges were upheld because there is the power to tax. And so, they called it a tax and ultimately upheld it. And it was a tax on people who were earning over 250, who had passive income. So it was for dividends, royalties, rental income, things like that. And was not going to be charged on active trade or business income. And so it was deemed to be a tax on the wealthy who had those kind of portfolio or passive income streams, and that they could, afford to have an extra tax to basically pay for Obamacare. And now you're just wholesale going across, our entire country for all small business owners. And if they, make over $400,000, you've got a NIT. So now everybody's paying the 3.8% tax. So it's introduced to just create an acceptance of this tax level. Now they're putting it, applicable to almost everybody. I find that to be remarkable, and I hate it. I think people who have their own businesses who are making $500,000, $1 million a year, employing people, taking those risks, it's just an unfair tax to put on them. But obviously that's not what this call is about. But it's an expansion. So if you have partnerships and S corps, we were all excited about QBID and things like that, right? And now you're looking at a NIT, expansion tax on what was otherwise, income that would not be subject to that. The other thing I wanted to point out, you mentioned the SALT issue, Andrew. Most of these things that are proposed are effective, starting next year. There's a couple of things that are delayed out 3 years, 5 years, 10 years. It depends on what the issue is. But for what it's worth for everybody on the phone, that SALT issue, if that goes through, and this is what we do have to pay attention to, is actually effective for this year. So you may be, wanting to, consult with your clients to go ahead and make those contributions for taxes, this year, for example. whatever, if they itemize, get to $80,000 in December of 2021, because if it goes through, that's going to be allowable. The hard part is we won't know if it's going through, perhaps, because it might get pushed till January. So tough issue. If it's just as easy for them to pay this year versus next year, you may just want to communicate to them, there's a chance you'll get the $80,000 benefit. There's a chance you won't. And they at least go into it with their, informed. But that's the only one that really is effective this year. Everything else follows.
I actually kind of want to continue talking about the SALT cap issue, because I find it a little fascinating. All of these states this year, passing all of their SALT cap workarounds, doing tons of legislative changes. I think it's 22 states have it either now or going into effect next year. And now all of a sudden, is it worth it to have done all of that? Are they going to continue doing those? Connecticut's is not even elective; it's mandatory. Is that going to change? It's so fascinating, because everybody looks at it as a federal issue, but really it trickles down to the states pretty quickly.
Yeah.
And can we just back up just a minute? And for those who are listening who might not have been on top of what the SALT issue is, can you just give a little more detail as to what's on the table with that?
I can take that. So the SALT cap currently for married individuals filing jointly is $10,000. So they can't deduct any more than $10,000 of state or local taxes. If you're married filing separately or you're single, it's $5,000. So under the current proposal, it would be increased to, I think currently it's $72,500, down from $80,000 was the original proposal. So that would be a revenue deficit for the next 5 years, but then switch back to raising money after the end of the 5 years, because it's still a cap. But a lot of states, in order to get around that and let their residents, continue to deduct those states, pass these so-called SALT workarounds, where individuals could pay their taxes essentially through their pass-through entities and have it flow through to them as a deduction. So I think about 20 or 22 states have passed those laws. Most of them elective. Connecticut, like I said, is mandatory as a way to get around it.
And just to for those on the call, I don't know all the experience on the call. Just for what it's worth, the idea is for those that itemize on their Schedule A, the typical strategy has always been, until this $10,000 cap came along, prepay your state and local taxes. And that way you do that at the end of December, and you get a deduction off of your federal income taxes, because you go on your Schedule A. When they put a $10,000 cap on that, that really gutted the benefit of that strategy. So if we do go up to, an 80,000, whatever it's going to be, at least we have that bigger chunk, and that covers most taxpayers. I think you're getting to, even into the top 5% of taxpayers at 80,000. So it was definitely a benefit. And there's pressure on Biden to deliver that, because think about where those states are that were impacted the most. It's New York, it's California, and a lot of Democratic states were hoping for some type of benefit like that from, getting a Democratic administration in place. So it's a very simple strategy. Just pay your taxes, pay your state and local taxes before year end, and you itemize, you get a deduction. It was gutted with 10,000. It becomes more effective for a lot of people at 80,000.
So, Sarah, one of the audience members was asking whether those SALT changes would trigger AMT.
That is a good question. I don't believe they would. If anybody else wants to jump in, my kind of gut reaction is no.
Yeah, no, it's no different than any of our other itemized. Yeah. They're non-preference items.
Okay, before we continue with some more planning advice, we'd like to display the second CPE code for this session. So that'll appear on the bottom of your screen. Be sure to make note of that if you're planning on collecting CPE for this session. Also, I just want to point out, if you haven't found it already, if you scroll down under the video window, there's an option where you can communicate with us and pose questions for our speakers. So feel free to click down there if you have any questions you want to get through to us. So let's take a look at what are some ways that we can recommend, or that you, our panel members, can recommend to our listeners, in which they can help their clients save money on taxes, either this year or in the future.
Well, actually,
Yeah.
before we go, I'm sorry to do this, but before we go there, I would like to talk about some of the corporate changes that I think are important too, if it's
Sure.
okay.
Yeah, sure.
Just because things we were looking at that haven't happened or the changes that are being proposed are compelling. One thing you guys have heard me talk about, well, the first is the obvious one. The corporate tax rate did not go up, right? So that's great, other than for public companies or assuming public companies that have over a 3-year average of $1 billion of income, there's going to be a 15%, alternative minimum tax there on their book profits, right? So they're looking at their financial statements and see if they're reporting profit and it's over $1 billion over a 3-year period, there's going to be a tax on that. So they can't hide behind, tax strategies and absorb their income that way. That's bigger company stuff that really doesn't apply to us. What does apply to us on the corporate side, in addition to that NIT issue, I've talked quite a bit about 1202 stock, with presentation of Core V and planning in the past. And the 1202 world is an area where if you invest in an active trader business that qualifies, under 1202, and you hold that stock, that C Corp stock for 5 years, when you sell under current law, you have 100% exclusion on tax, right? So there's no capital gains tax. And that's a really wonderful provision. Again, my world is private business owners. So I think that's a fantastic provision in the code to motivate people to create businesses and hold them for the long term and grow them. So that 1202 provision used to be, when I started practicing law way back when, was a 50% exclusion off of a 28% capital gains rate. So if you held stock for over 5 years and you were still a qualifying business and you would sell, you would get a 50% exclusion on your cap gain event. And that was wonderful then. So you would net a 14% tax rate in effect versus a 28% tax rate. That then changed subsequently about 10 years later to a 75% exclusion, which then changed again to become the 100% exclusion that we were dealing with recently. And people weren't really taking advantage of it a whole lot until we saw the C Corp rates go down to 21% under the Tax Cuts and Jobs Act, and then everyone's talking about 1202 again. So you could have a C Corp running at a 21% rate, and you would have a potential exemption, a full exemption on sale of your stock, either $10 million or 10 times basis. So wonderful tool. And what happened in this act is really important for all of us. I think most of us represent small business owners. The NIT is one thing, but this 1202 is another. There's a lot of us were pushing on this 1202 C Corp play. And the proposal is that we're going to get rid of the 75 and 100% exclusion amendments that came along and go back down to a 50% exclusion. So that means that, somebody who's making under $400,000, the laws are the same. The 100,000 is still there. The 100% exemption is still there. But if you're over 400,000, which is basically every business owner I know, if they're selling, their business, you're going to have AGI over that, and you're going to have a 50% limit. So still the same parameters of $10 million exclusion or 10 times basis. But the one thing that people don't realize is that when you're dealing with capital gains rates, when it was 100% exemption, we didn't care on which rate we were dealing with because it's 100% exemption. But a lot of people don't know, it's pretty obscure, that if you sell 1202 stock, that the capital gain rate, even though we may look at it and say it didn't go up to 25%, it's staying at 20%. For 1202 moving forward under this provision, the original rule ties it to the 28% tax rate. So there is actually two capital gain. There's a 20% rate that we all know of when we think of selling stock. There's an exception to that if you're selling collectibles or you're selling, 1202 stock, a qualified small business stock, that the rate that applies to that is actually 28%, right? So when we think in terms of communicating to the client, say, yeah, it's a 50% exemption. Well, it's really not, right? 20% is what we think of as cap gain. You're really getting down to 14%, so it's not a full 50% reduction for what that's worth. So I know that was a long, but people need to know that. That's a big deal because we have a lot of people in the 1202 space, a lot of C corporations And so it's going back to the original rule of 50% exclusion, but to note that it's 50% off of 28, not 20. So I want to get that out there before we move on. I think it's important for people to know.
Yeah, Jim, thank you for that. And I think to answer Gail's question on, what advice can we give to clients? I think I would kind of break the answer into two sections. The first section, I would say, one of the things I've seen that's most difficult for tax advisors in the last 2 years, but also when you come to the end of a year like this, is the first one is kind of setting expectations, and then we can have Jim and Sarah share some specific strategies. But the first thing is setting expectations. One of the things I think that really drives people crazy is the idea that, okay, I've got to give my normal advice to my clients based on what's going on, like I normally would in any particular tax year. But then you come into a situation like this year where you've got 3 different pieces of legislation, 2 of which have passed, 1 of which hasn't passed, some of which have retroactive changes. So I may have already given my client advice that then needs to be, reversed at a certain point. You see that with the Q4 ERTC. You might see that with the SALT changes. And so, Jim and Sarah, I'd love to hear your thoughts on how do you recommend people set expectations, knowing that they could give a piece of advice that is 100% right now, but the exact opposite piece of advice might be 100% right 30 days from now, even though the client might have made decisions. And how do you manage that? And then what specific strategies would you be recommending at this point, given where we're at today?
A well-written engagement letter.
Yeah. Cover your ass, I'm sorry to say, but it's...
Disclaim everything.
Yeah, you really want to make sure they're properly informed. I mean, it is a time of uncertainty. For example, I go back to my SALT example, right? I think you tell everybody, but you do it and you send emails. Don't do this just in a phone call or a meeting. I think you want to make sure it's in writing. An engagement letter that walks through the current, kind of uncertainty in the arena is a great idea. You may not have the luxury of that because you have an existing client where you're not going to get a new engagement letter, right? It's just ongoing. So at least have it in writing whenever you're talking about any of the strategies that, while this is not yet final, this is what's been proposed. If effective, it would be next year. If you did this, if you did it this year, then this could be the effect. If it doesn't go through, blank, right? So in each case, you may have to work that through. The SALT, example is a good one. That's probably an easier one to recommend because if you're not getting if you're capped, it's really just a time value of money issue there. So there's probably a little downside to expediting a payment that you're going to make anyway. That's an easy one. Telling somebody to sell their business, because the tax rate was going to go up and then it didn't. And then, they could have had a higher multiple in the following year. Also, those are harder statements. So you just have to be very careful with it. And everybody's got to say it is impossible to know what the final act is right now. This is what's been proposed. This is what's expected to go through. We don't know the timing. There will likely be some adjustments between the Senate version and the ultimate, and what goes back to the House to reconcile. And I tell people, listen, the estate exemption, did not go down to 5. But when we get through all this, maybe it does, right? Maybe that does happen. I have no idea. Maybe corporate rates do go up to 26.5%, right? I doubt it. I think all that has been set in stone because of Manchin and Sinema. But I do think you have to hedge yourselves. You got to give yourselves cover. So just be careful in how you write things and let them know this is not final. This is what's been talked about. This is not final. If it is final, this is how we would, these are the things we would do. So you can't write it enough. So Sarah, I think you're thinking the same way.
Yeah. And then, I mean, I know it's hard to encourage people to have a flexible mindset when it's the end of the year and they have a lot of assets or money in play, but you have to keep that in mind. You have to be willing to switch gears for people.
Yeah. And I'll give an example. Here's another example that it'll tie into strategy to segue into that, but also hit on a thing we didn't touch on yet. The IRA world, right? That's a significant change as well, is in the IRA space. What they're proposing is if you have an IRA worth more than $5 million and you have the AGI over 400, you can't contribute to that IRA anymore, period. right? And if you are over 10 million, they're going to require RMDs sooner, up to 50%. And if you have, IRAs that double in value over a year because of some self-directed play that, bumped up in value, they're going to force a distribution of that asset out to you. So there's a lot going on in the IRA space, right? And what's being proposed, at least. So I have clients right now with very significant IRA balances. I should say one more thing before I go there, is they're also eliminating the backdoor IRA, the Roth conversion, right? So many great strategies out there. And thanks, Peter Thielen, right, for that headline, where you have a $5 billion self-directed IRA. That didn't help anybody's cause. And so these mega super fund IRAs, these backdoor conversions where you go from your traditional to a Roth and you trigger the tax to move it into a tax-free situation. Very common way to get into a very tax-free environment. And if you self-direct, all the better. So you have these, mega $1 million, Roth IRAs that are self-directed into private company investments. And, they're just too good to be true, right? So of course, now we have this legislation. All right. All that being said, if, that's a lot to unpack with respect to IRAs in this legislation. So I have clients right now, with multi-million-dollar balances who actually are converting. So a strategy would be convert now or forever hold your peace, right? Get into a Roth IRA, do the backdoor today, because you may not be able to do a backdoor tomorrow, right? And that's so a strategy has to be discussed. Hey, we may want to convert now with your $1 million balance or $2 million balance because it's not yet 10. Let's get into the tax-free situation while we can. And that's really good advice. Unless it turns out that the law never changes and then you triggered a tax event on a multi-million-dollar IRA, right? So, you're really kind of stuck as an advisor there. And so we just have the communications that you got to walk through the permutations of what could be, right? It could be that you incur no tax and you keep it in a traditional format and it grows and grows and grows. Or you incur a tax now. You're going to reduce your principal, you're going to pay a tax, and you're going to get into another form. Who knows if that form is going to be helpful down the road? We don't really know. So you kind of have to hedge when you go through that. And this act is putting that very clearly in front of you that you have to work through the options with people and say, this is good if, and if it doesn't happen, just know we went into it with our eyes wide open.
Okay, so let me interrupt here. There's a lot of uncertainty. That's definitely the theme of this session. Can you guys, I'm going to call on Andrew because he's been quiet for a little while, but can you outline a few of the things that have actually changed in the law for 2021 and just the short list of what people need to focus on?
Sure.
Yeah, I think, whenever we look at this time of year, obviously there is a lot of uncertainty. And when you look at it, you can look at the American Rescue Plan, and then you can look at the infrastructure bill that have been passed. And those different provisions are really the ones where we can hang our hat and have some certainty. One of the items that I think is hitting everybody just recently is in the infrastructure bill that was passed. We had the employee retention credit that basically ceased to exist for Q4. And so that was one particular item. Employee retention credit has been hugely popular this year, right? Hugely popular for so many of our clients. And it's a great strategy. And still, if your clients haven't taken advantage of that for previous quarters, that's something that really should be assessed across every person. But it's an interesting example now because you have people that still need to do it, but then you have people that actually took it for a portion of Q4 that's now been disallowed. And so they actually have, those amounts need to be paid back. And so for any of us that had clients that are in that situation, I think that's one that I would absolutely recommend looking at. And I think one of the unique things about this year, as opposed to last year, I would say, is there were a couple of strategies like ERTC that applied to so many clients. But really, when you look at the rest of this year, I would say that many of the items that we talked about on this call, like the NIT, like the 1202 stock, and some of these other items, where it's really going to be going forward a situation where a lot of these changes might not apply to every single one of your clients. But if you're doing 300 business returns or 500 business returns, And you've got to look at, okay, who falls into these different categories of issues and then approach them directly. So it's something where not as many of the changes going forward are going to apply blanketly to every single client, like a change in capital gains rates would have, or a change in individual income tax rates would have. So I would say, that was a couple of the items. And Jim and Sarah, what are some of the items you would say this year that you're focusing on that have already been passed that we need to make sure we cover before now and the end of the year?
I know charitable giving is probably a pretty big one with the suspension of those, the AGI and the taxable income limitations, and that expires at the end of the year. So if people are looking to take advantage of that, they would need to do it before the end of the year.
Yeah, that's my number one right there. That's the most compelling, is that you have some dramatic increases in the percentage of the deductibility there. And as far as that kind of tax planning, there's little question around that, and it's straightforward stuff. It's just getting through the mechanics of a charitable structure for a client, right? Is it direct to a charity? Is it to a donor advised fund? Do you create your own foundation? Is it a charitable lead trust? Is it a charitable remainder trust? There's a lot there in how you create those structures. So there's planning opportunity there while we have these higher deduction limits. And it's, something that I would push for sure this year.
Thank you so much. And then I just have one question that just came in from the audience, which is the conversion to a Roth going away only for high value IRAs?
Yeah, definitely. Well, I should say the conversion is for anything over. I still think you're dealing with an income limit of 400,000. I think you can convert still if you're under 400,000.
Okay, we had another question that came in. Does the same rule on an IRA over $5 million apply to a 401k or a pension balance?
Yeah, so the defined contribution plan is going to be stuck into that same trap, unfortunately. And that's usually the approach, right? You take your 401k, you drop it to an IRA, and then you roll that to a Roth IRA. So that's the back door, right? That's what they're trying to avoid.
Okay. And another audience question, going back to the 1202s, will 1202 be retroactive for past sales that are on an installment agreement?
I don't think so. We don't know until it's final, but right now, no, it's going to be, for future sales.
Okay.
I think it would apply for sales as written. Isn't that the one? I believe it was the end of the year, right?
Through the end of the year.
Yeah.
Yeah.
But who knows?
Yeah.
Like that's the theme of this is who knows?
I want to highlight on I think the estate side deserves quite a bit of time too. I don't want to overdo it, but I want to highlight that, through the multiple iterations of the acts, plural acts, that went through this year that were proposed, there were a lot of recurring themes from prior years and prior committees and task forces. Let's get rid of GRATs. Mm-hmm. Let's get rid of family partnership discounts. Grantor trusts, are going to be now included, in your estate down the road if you had a grantor trust. So a lot of that didn't go through, which was really wonderful for us. The biggest thing that didn't go through was under the Sanders Act, for the 99.5% Act, was to basically get rid of step up, right? That was probably the most important. Those two things, the getting rid of dynasty trust, getting rid of step up in basis, having grantor trust be included in the grantor's estate, those were massive proposals. And none of that went through, right? So from a planning standpoint, I also want to highlight that they keep attacking these areas, introducing new areas like the GRATs, and discounts are always up there on the list. So one day it may go through, right? They get rid of the whole short-term ladder GRAT, structure, the zeroed out GRAT. But the introduction of getting rid of step up, the introduction of a 50-year tax, not allowing, perpetual trusts that avoid estate tax or GST tax, and getting rid of the step up basis is a crazy thing, but those are now out there. So for year-end planning now, I would say this is where it's nice to know when things aren't final is, try to plan with those types of trusts the best you can now, because really with all those suggestions, they were being grandfathered. to the question before. So a lot of them, the provisions were grandfathering prior trusts. So I do think there's quite a bit of a push to integrate the estate planning into the ownership of the businesses and the other assets now, because they keep ticking away at some of these strategies. And I would say there's motivation to get those in place while you can.
All right. Well, people now, they're getting excited. They just keep asking more questions now. These are the first one is here. It's about charitable contributions. Are contributions to donor-advised funds limited, or do you get 100% AGI? This sounds like a similar question. It just says charitable going to a donor-advised fund. This is still limited to 60% of AGI, even in 2021. Is that correct?
Sarah, you want to take that?
Sure.
It's if you don't know, yeah, it is. It's 60. I don't know
it is. Yes.
Yeah.
Sorry, I'm trying not to cough.
I know you're coughing. Sorry. Yeah. You brought it up, so I didn't want to take your thunder.
Oh, sorry. And obviously the other limitations are in effect too, the 30% and the 20% with the other types of property.
Yeah.
I have a question I want to jump in here with, and while I'm asking the question, I'd like to go ahead and post the third CPE code for this session on the bottom of your screen. So be sure to keep track of this if you're planning on collecting CPE for this session. I also want to mention we are giving CE credit, IRS CE credit for this session as well. So when you registered, you were probably asked your PTIN number. If you didn't supply it then, you can supply it when you go to claim your credit at the end of the session or the day or end of the conference. But the question I want to jump in with is, every year it seems like there are always one or two things at least that are sunsetting that in prior legislation that was set to expire. Are there any things on the list this year that are either set to expire or we thought were going to expire and maybe they're not going to? Where are we on that?
I'll mention one.
We're all jumping in.
Yeah. I'll take the easy one, fun one. The meals, right? So meals, it looks like will be going away, the deduction for 100% meals. So the strategy, I think, for everybody at this point is to make sure you get all your food in for 2022, and then 2023 you don't need to eat, right? So,
Right.
So that's an easy one.
Another big one I know is going to be the bonus depreciation phase out. 2022 is going to be the last year where you can take that 100% bonus depreciation deduction. I mean, it's going to go down to 80%, which is still a good amount, but starting in 2027, that's going to be a zero amount. Although again, who knows, it could come back.
I did want to make mention today on the qualified opportunity zone world. That's still very real to us, but it's been a changing law for those that don't know with the QOZs. If you have a capital gain event, and right now we have a lot of people who have capital gain events, right, because they were expediting, thinking the rates were going up. And they're going to say, how do I offset this? Well, it could be charitable. It could be, some of those strategies. It could be 1202. That's helpful. But the other idea too is investing. You take those proceeds and roll them into a qualified opportunity zone business or its own real estate or a fund. And the qualified opportunity zone is the intention there is to invest in, I'm going to say it in quotes, distressed areas, because they may not be so distressed. They're 10-year-old census numbers, and governors got to self-select where they want you to invest. So just call it areas of developments, we'll say. And you can invest in those areas and you can roll your capital gains into those and defer your cap gain. So in the first 2 years of the rule, you were able to actually offset ultimately a piece of your capital gain that was a reducing amount. Where we're at now, what's expired is you no longer are going to get a reduction in your capital gain. You'll get deferral, which will trigger in 2026. But then all the gain thereafter, whatever your principal is going into your QOZ business or the fund, and you hold that for 10 years, that's still going to apply. Even though we're losing the deduction element now, you can still roll your cap gain and get deferral for a few years. So you get time value of money while you invest in another business or real estate. And then whatever that grows to, if you hold it for over 10 years, you can avoid all cap gain on that under the current law. So people are talking less and less about QOZs because we don't have the reduction component because it doesn't have that same sizzle. But if you reload into another investment and hold that for 10 years and you avoid all cap gain on that, that's actually a pretty good deal. So I think QOZ should still be talked about, even though they're phasing out.
Yeah, and I mentioned it already, but the ERTC done in Q3, anybody that took it in Q4 does have to actually repay those balances. And there are actually some dates. I believe it's December 21st that if you do repay, you can avoid penalties, or you can apply for penalty relief if you have a reasonable cause as well. And one of the items there to note, though, is over the last couple of weeks, there's been sort of like, is the virus getting worse? Is there another variant? That some of us have probably heard of these conversations. And so there's actually a discussion about extending that ERTC beyond that. I would say it's pretty low likelihood, but there is some discussion that we've seen on that point. But as of right now, it is over as of the end of Q3.
All right. I want
Well, except for the recovery startup. The recovery startup is still available to companies who qualify for that credit. But everyone else is out of luck.
Okay, cool. I want to thank all of you so much for incredible insights and so much information for us to think about as we're talking with our clients approaching year end here. And first of all, Jim and Sarah, thank you for your time. Really appreciate your joining us for this call. Andrew, great job. So thankful for all of you to be here, and also we're so thankful to Corvi for sponsoring this session. And right now what I'd like to do is remind you all that we will be back at the top of the hour. You don't want to miss the next session. It's on data security, it's the law. And then we've got a lot of good insights coming up for you in that session. And then also we want to turn this over to Andrew to talk a little bit with you about what Corvi is and why you should know about it. So Andrew, the floor is yours.
Gail, thank you so much. And Jim and Sarah, thank you for doing this session as well. We got such good feedback last year being on Ensuring Success that we wanted to come back and talk a little bit more about tax planning in detail. And so for today, I'm going to share a couple of minutes of kind of what we've learned and how we're helping clients at Corvi. Most of the people on this call are either, practitioners at a tax and accounting firm or a firm owner. And so we'll walk through a little bit about, how we're approaching clients in sort of this crazy year and how we think about planning and how it's a little bit different than tax preparation. So can everybody see my screen, Gail? Are we good to go on my side? I know. Let's see. I think yes. Good. Let's see.
Yes.
Good to go. Okay, perfect. And so real quickly, what I'm about to show you is a little bit of our actual product, Corvi Tax Planning Software. We were very fortunate to be #1 for advisory products for 2021 from Accounting Today. Also, we were a finalist for the 2021 Innovation Awards for CPA Practice Advisor, which was a huge honor as well. And then our organization, we were very fortunate to be in the Inc. 5000 this year, which was great, not just for all of our users and our customers, but also all of our team members. And so I'm going to go through and do a little bit of a demo. I'm going to walk through our Corvi tax planning product, which covers the federal level today. And I'll give you a little sneak preview on some of our state and local releases, which will be out here literally in a matter of days, weeks. So I'm going to go ahead and share my screen here and come out and show you a couple of items. So this is an example, and I'm going to go in here and show you of a client. This is Sarah Jones, a sample client here. She's an individual with a Schedule C, a C corporation, and a Schedule E. And when you go in, we can actually send requests to clients for everything that you would need for tax planning, right? So when we think about tax planning, we think, okay, how do we look at things that they might be doing in the past that were incorrect and things that they could do in the future to change their facts and circumstances to, pay even less or have a more efficient tax structure. And so when we look at it, we've got the individual, the Schedule C. If I go in as an example to the Schedule C, I can see that right out of the gates, if I were to switch to an S corporation, Sarah would be able to save $6,100. We can come down here and see all sorts of strategies. So we can see legal entity changes, we can see deductions, we can see retirement, depreciation, insurance, Tax Cuts and Jobs Act, the CARES Act, FFCRA, exit and capital gains, real estate, niche specific, advanced, international, and so forth. And one of the questions I get a lot is like, what is a strategy? And strategies can be simple, strategies can be complex. I'm actually going to show you some state and local planning strategies today. But when you take a look at any of these strategies, what you're going to see is basically the ability to come in and say, okay, what are the key details that I need to know to calculate what would be a deduction or a credit for a client? So this is a basic ERTC strategy here. And then depending on what entity type we have, some strategies are different based on the entity type. You actually go through and show the calculation to arrive at the deduction or the credit. And so in this example, you can see a $24,000 credit on the ERTC. all the detailed documentation supporting that. So you can see that as well, what entities it works on, if there's any conflicting strategies and so forth. And so, you could do this by year, you can look at it by entity, and that's just an example of one strategy. I mean, there are literally thousands and thousands of strategies that are out there. And that's a specific strategy that can be applied to a business client, but we've also got individual strategies as well. And when you look at this, all of this comes together. So you can go through and look at, okay, for each entity, right, the individual, each business as well, what could we do and how much could we end up saving? You can see in this example, the individual side, we can save $3,700 on the Schedule C, $27,000 on the C Corp, $3,200 on the Schedule E, $11,000. And you can actually come in here and send a plan right over to the client. Say, hey, here would be the plan that we could go through to get you to a more efficient position overall. And so you can see here for each entity in the current year and the future year, what the savings would be. We go through a number of other slides, then we actually break down everything individually. So you can see on the individual, very basic strategy on the 401k. These are some high-level diagnostic details from their return. And then you actually go through the strategy. So you can see supporting documentation here, including IRS or court case references, and you can see the detailed calculation. Now, I did want to show you all of this today, which is our current product, which if any of you are interested, you can go to corvi.com/demo. I'll share the link at the end of this as well. But I did want to give you a little sneak preview as to how we're doing actually our state and local tax planning product, which is out in a matter of days. But I'm going to give everybody here a little sneak preview. So what's really cool is obviously whenever you're making these recommendations to clients, you end up having a federal tax savings, but you also end up having state implications for that, right? You might have a corporate rate. If we're talking about a C Corp, you're going to have individual rates if there's individual tax in the state. But then there's also these really tricky taxes like franchise tax and excise tax and others and so forth. And so when you come down here, you can see, okay, so at the federal level, we have a savings. At the state level, we have a savings. And you can actually see those calculated, all of the IRS and court case references as well. And then you can actually go into the specific state. And what our team has done, Sarah being on our team as well as many others, they've gone through all of the individual states to look at each of these strategies to figure out, okay, where is the specific state law? Is this a conforming strategy? Is it a non-conforming strategy? If it's non-conforming, is there an adjustment? Is there a reversal? Is it a custom calculation? And then also a variety of the information that's relevant to that state in particular. So we do have that as well, which is very, very helpful. And so all of this comes together to show you for that particular strategy. But the other thing that I did want to show everybody here today that is really cool, as we have just a couple more minutes left, we also provide what is called a multi-entity tax calculation. How many people here are doing tax preparation in the chat? Just let me know, right? If you're doing tax preparation. One of the biggest challenges when you're doing tax preparation is you might schedule, or you might file the business return early in the year. You might file the individual return later. Like you never really sit down and see how everything affects everything. In this example, though, we can see all of the taxes that are on the C Corp, all of the taxes that are on the S Corporation, and all of the taxes that are on the individual. And you can actually drill down and say, all right, so what's going on the S Corp on the federal level? And you can come down here and see where are your strategies fitting in specifically before you do planning, after you do planning, what's the difference? And ultimately that arrives up here into our tax savings. This is total tax by type by entity. And then you can also see all of that flow into the individual. So you can see here, everything that's outflowing from the S Corporation to the individual, you can see all that here, and then you can see it on the individual side as well at the federal and state level. So very powerful to have a multi-entity consolidated tax calculation, which gets to savings for clients. And so I am at the end of my presentation today. If any of you have questions about CoreV and working with us, and you want to get more information about how to save your clients money in taxes, move from tax preparation to tax planning, I would recommend setting up a time with our team, and we will cover all of the states soon. You can go to corvi.com/demo, and I will see you on the other side. Gail, I'm going to go ahead and pass it back over to you and your team. Thank you so much for having us on today.